Good morning. This is Global Markets Daily Brief for Sunday, April 5th, 2026. I am Jonathan Simkowitz. Every major headline today is about the language, the expletives, the tone, the spectacle of a sitting president posting profanity on Easter Sunday, threatening to turn Iran's infrastructure to rubble by Tuesday evening. But the capital allocation question is not about the words. The question is whether this Tuesday deadline is a genuine trigger for kinetic escalation or whether it is the third iteration of the same pattern, a deadline that rolls, buys time, and keeps markets oscillating between fear and relief. Because the answer to that question determines whether Brent crude sits at 109 or breaks toward 150. And it determines whether the Federal Reserve is managing a temporary supply shock or presiding over a structural inflation regime. That is the deeper question. So, let us work through it. Here is what happened. President Trump posted on Truth Social this morning threatening to destroy every power plant and every standing bridge in Iran starting Tuesday if the Strait of Hormuz is not reopened. He used explicit language, referenced religion, and called Iran's leadership, in his words, crazy. This follows his Saturday post giving Iran a 48-hour ultimatum. The deadline on his original 10-day window expires Monday. He has now specified Tuesday at 8 p.m. Eastern as the moment strikes would begin. Brent crude settled Friday at roughly $109 a barrel, up nearly 8% on the week. West Texas Intermediate closed above 111. The physical market is even tighter. Dated Brent, which reflects actual cargo pricing, reportedly traded near $140 earlier this week. That gap between the futures price and the physical delivery price is one of the most important signals in this entire crisis, and we will come back to it. Equities have been whipsawed. The S&P 500 has been down roughly 8% since the war began in late February. Bond yields have climbed, with the 10-year touching 4.46%. Gold is above $4,500 an ounce. The dollar has strengthened against most emerging market currencies. Iran, for its part, struck a petrochemical complex in Kuwait today. Israel struck a major petrochemical plant in Iran yesterday. A key advisor to Iran's new supreme leader threatened to close the Bab el-Mandab Strait, the choke point connecting the Red Sea to the Gulf of Aden, which would effectively shut down Suez Canal traffic as well. And OPEC Plus met today in Vienna, agreeing to a largely symbolic paper increase in quotas for May, while acknowledging that actual supply from the Gulf remains physically constrained. That is the first-order reaction. Let's step back. The consensus framing right now runs something like this. Trump is escalating rhetorically to force Iran to the table. The deadlines are negotiating pressure. He has issued and then extended deadlines before. On March 21st, he gave Iran 48 hours, then extended it to 5 days, then pushed it to April 6th. Each time, markets sold off on the threat, rallied on the extension, and returned to a nervous equilibrium. The consensus believes this pattern will repeat, that Tuesday will come, there will be some form of indirect diplomatic progress or another stated reason to delay, and the cycle will continue. There is a reasonable basis for that view, but the consensus may be incomplete in 3 important ways. First, the physical oil market is telling a different story than the futures market. The Strait of Hormuz has been effectively closed to conventional shipping since mid-March. A narrow corridor controlled by Iran's Revolutionary Guard allows select vessels from China, Russia, and a handful of allied nations to transit, reportedly for fees of up to $2 million per crossing in Chinese yuan. But the traditional flow of roughly 20 million barrels per day through that waterway has collapsed by more than 90%. The International Energy Agency has called this the largest supply disruption in the history of the global oil market. The head of the IEA warned this past week that March was cushioned by cargoes already in transit before the war began. Those cargoes have now arrived at their destinations. In April, he said, there is nothing.
What that means is that the world has been drawing down strategic reserves and redirecting pipeline flows to mask the severity of the disruption. The United States and IEA members have released a record 400 million barrels from strategic stockpiles. Sanctions on Russian and Iranian oil have been temporarily lifted. Saudi Arabia and the UAE have rerouted some volumes through pipelines that bypass the strait, but those measures are finite. Analysts at BCA Research estimate the world has lost roughly 4.5 to 5 million barrels per day so far. That number could double by mid-April as the cushion disappears. Second, the escalation pattern has changed. This is no longer just rhetoric followed by restraint. The United States has already struck bridges, radar installations, and infrastructure inside Iran. An American F-15 was shot down over Iran this past week. The pilot was rescued after days on the ground inside Iranian territory. Iran has struck targets in Kuwait, the UAE, and across the Gulf. Israel hit an Iranian petrochemical facility yesterday. Iran's Houthi allies have entered the conflict and are now threatening Red Sea shipping, which carries roughly 22% of global container trade. The geography of this conflict is expanding, not contracting. Third, the domestic political calendar matters. Gasoline prices in the United States have crossed $4 a gallon and are climbing. The next Consumer Price Index report drops on April 10th. Economists polled by FactSet expected to show March inflation at 3.1%, up sharply from 2.4% in February. This is happening while the labor market is weakening. Employers shed 92,000 jobs in February. The revised figures brought that loss even deeper. The Fed has held rates steady and is now widely expected to deliver 0 cuts in 2026. CME FedWatch data shows a 95% probability the Fed holds at its April 30th meeting and a 77% probability it holds again in June. This is the setup for what economists call a stagflationary impulse. Growth is slowing, inflation is accelerating, and the central bank's hands are tied. Now, what is priced in versus what is not priced in? The futures market for oil, around $109 on Brent, reflects a scenario in which the strait remains mostly closed through early to mid-April, but reopens within roughly 2 to 4 weeks. Goldman Sachs raised its Brent forecast to average $110 through April and warned that if disruptions persist at current levels for 10 weeks, daily prices would likely exceed the all-time record of $147 set in 2008. What is not fully priced in is the possibility that this drags into May and June. If you believe the deadline extension cycle can continue indefinitely, the current oil price looks roughly fair. If you believe Tuesday represents a genuine inflection, either toward actual strikes on power plants or toward a credible diplomatic breakthrough, then the current price is mispricing the tails in both directions. Equities have partially discounted the energy shock, but have not priced in the second-round effects on margins, consumer spending, and earnings. The S&P 500 is down 8%, but corporate guidance has barely adjusted for the possibility that oil stays above $100 for a full quarter or more. The bond market is closer to getting it right. Rising yields reflect the reality that the Fed can't cut into an energy-driven inflation spike even as growth deteriorates. But even bonds may be underpricing the fiscal implications. Defense spending is surging, the Strategic Petroleum Reserve is being drawn down at a historic pace, and the political pressure on the Fed to ease is intensifying, just as the economic case for easing is weakening. My base case is that Tuesday does not produce the large-scale infrastructure bombing campaign Trump has described. The pattern of escalation followed by extension is deeply embedded in this administration's approach. There are indirect talks underway through Pakistan, Egypt, and Turkey. Iran's foreign minister signaled willingness to join negotiations on Saturday. The rescue of the downed American pilot removed one potential obstacle to continued diplomacy. I assign roughly 55 to 60% probability of another extension or a narrower, more targeted military action followed by renewed diplomatic language. However, my base case also includes continued closure of the strait through at least mid to late April, with the physical supply crunch intensifying as strategic reserves deplete and pipeline alternatives reach capacity. That means oil prices remain elevated, possibly grinding higher toward 115 to 120 on Brent, with the physical market diverging further from futures pricing. Inflation prints remain hot through the spring, the Fed stays on hold indefinitely, and equity multiples compress further as the market begins to price in the drag on consumer spending and corporate margins. Now, the trade-off matrix. In the base case, which I weight at roughly 55 to 60%, the strait remains closed through late April. Oil holds between 105 and 120. Strategic reserves continue to be drawn. The Fed holds rates at every meeting this year. Growth expectations for the second half are revised downward.
Equities drift lower on margin compression. Energy and defense equities outperform. Rate-sensitive sectors like housing and consumer discretionary underperform. The dollar holds its bid as a haven. In the bull case, which I weight at roughly 15 to 20%, a credible diplomatic framework emerges within the next 10 days. Perhaps a partial reopening of the strait under international supervision, or a ceasefire in exchange for sanctions relief. If the strait begins to reopen, Brent could fall rapidly toward $85 to $90. The war premium unwinds. Equities rally hard on the relief trade, particularly airlines, consumer discretionary, and rate-sensitive sectors. The Fed regains optionality to cut later in the year. But even in this scenario, the IEA has warned that insurance costs, freight premiums, and a lingering geopolitical risk premium would keep energy prices structurally above pre-war levels for an extended period. And the damage to Gulf infrastructure, including Qatar's LNG complex, which was struck in March and may take 3 to 5 years to fully repair, creates a long tail on global energy pricing. In the bear case, which I weight at roughly 20 to 25%, Tuesday's deadline is real. The administration follows through with sustained strikes on Iran's power plants, bridges, and energy infrastructure. Iran retaliates by escalating attacks on Gulf state infrastructure, potentially closing the Bab al-Mandab Strait through its Houthi allies. This would simultaneously disrupt the Strait of Hormuz and the Suez Canal corridor, affecting more than 40% of global seaborne oil and container trade. In that scenario, Brent moves rapidly toward 140 to 150 or higher. Global recession probability rises sharply. The Fed faces an impossible dilemma. Risk assets sell off broadly, with the S&P potentially testing levels 15 to 20% below current prices. Safe haven assets, gold, the dollar, short-duration treasuries outperform dramatically. What to watch this week? The first trigger is Tuesday itself. Not just whether strikes happen, but the scope and targeting. Strikes limited to military targets would be very different from strikes on civilian power plants. The language of the threat has been civilian infrastructure. The execution will reveal the actual policy intent. The second trigger is the April 10th CPI print. If March inflation comes in above 3% as expected, it will functionally close the door on any Fed easing in the first half and could reignite talk of rate hikes. Watch the bond market's reaction to that print more closely than the equity markets. The 10-year yield is the signal that matters most for the real economy right now. This is market commentary, not financial advice. Markets move on narratives. Capital moves on probabilities. If you found this analysis useful, subscribe to Global Markets Daily Brief, share it with a colleague, and come back tomorrow because the next 48 hours may redefine the risk landscape for the rest of this year. I am Jonathan Simakowicz. Thank you for listening.